All right, folks, we're gonna just start it off. I'm actually gonna continue to let people in, but let's kick this session off because we all have a lunch and very limited time, I'm sure. So, firstly, thank you so much for joining us today for our capital raising virtual event. This is what to expect when you're expecting an investor. My name is Ryan Burns. I am the head of community here at the Startup Network. It's such a thrill to be joining all of you for one of our signature virtual events that we bring to you with our partnerships with a variety of players across the startup ecosystem. Today, we're joined by our friends at Allied Legal. Today, we're going to go through a bunch of different items, and I'll let them kind of tackle the subject matter themselves. But it should be a really good event. The way the format of the event is pretty open. We're going to do a little bit of a chat first, hear some great talking points, and learn a bunch of items. But at the same time, we want it to be interactive and for you folks to have the chance to ask any questions that you might have on the top of your head. Best way to ask those questions is just put them right into the chat. I'll be in the chat as well to make sure that we guide you through this topic with detail and care. But also, please, if you have any unique questions that are unique to your situation, we can answer them in the chat, or we can always take them offline afterwards too if they're a little bit more specific. Also, just to let you know, we are going to be recording this session. So if you have any questions afterwards, we will have the ability for you to look over this event after. This is a part of the Startup Network's variety of events where we bring a lot of different angles and topics to you about startups. Today is obviously a very big topic for us, but we also have many, many more. So, for instance, a little bit later this evening, we are partnering with our friends at Think and Grow for a Are You Ready to Go to Market event, and it'll be at their offices here in Melbourne. We also have several other virtual events lined up this month, and we will be also doing a lot of virtual in the near future into June as well as to July. And then finally, we have our signature events, which are Founder Connect, and also the Pitch Night. So this month will be Climate Tech Pitch Night, and it should be a really good one. We'll have our applications open for anybody that wants to win that $200,000 prize. If you are in the area of climate tech, please do apply. But for now, I will hand it over to my friend Rahul, who's going to guide us through this wonderful, fantastic topic from Allied Legal. Rahul, go ahead and take it away.
Thank you, Ryan, and hi, everyone. Look, as a starting point, really appreciate the opportunity that Startup Network gives the likes of us at Allied Legal to be able to present and share our insights. Today we are talking about capital raising, and raising funds is obviously a critical juncture in the case of any business that is growing and scaling. And I think the Startup Network does just a phenomenal job at bringing the community together and allowing people within the ecosystem to share their knowledge and their expertise. And I would really encourage you to get to all their events and some of those that Ryan mentioned. So, in terms of the topic, what to expect when expecting an investor, a fun title, which will really cover off on a variety of things today, which I hope you find useful. While I'll be touching on some of the legal issues with raising capital as a startup, I'll also be honing in on the commercial aspects of funding, right? Because those are the more interesting things that investors look for. And so some of the topics we will cover today will be the capital raise journey and I'll talk you through that when funding and issuing equity in your business, the concept of the value of death. I know that sounds fairly big and scary, but it's a very interesting concept and something we like to touch upon as part of the fundraising topic that we do. What a typical investment round looks like. The impacts of dilution, what to look for in an investor. So what does a great investor look like? Structuring your investment, and then we'll touch on sort of disclosure and due diligence, and we'll have some time for Q&A. And as Ryan mentioned, if you want to ask questions as we move along, I think he said he would be happy to moderate, which I appreciate. So Look, as part of our job as startup lawyers, we are specifically focused on working with startups, and we have acted, while not at the same time, obviously, but for both investors and startup founders in fundraising transactions. So we're very well placed to speak to this topic today. And the focus of the chat today is really about raising equity or capital for from a strategic investor or investors in the ecosystem, right? And some of the considerations you should be turning your mind to. And aside from that being one avenue to raising funds, as Ryan mentioned, the startup network, they give out grants and prizes and other means of non-dilutive funding, which you should always also keep in mind as a founder. So with that, let's move on to what we are the capital raise journey and the slide on your screen now. So this slide sets out essentially what the typical fundraising journey looks like. So at the outset, when you're gearing up for funding, the team of founders should have your pitch deck or investor presentation good to go, so that you can start reaching out to potential investors to share with them more about your startup, your business, and we'll talk about what a good pitch deck should cover off on. From there, you would normally have a group of trusted advisors, which would normally include legal, accountants, corporate advisors. Perhaps you might have some of that intel within your group of founders or co-founders. And so you should start gathering that team and assigning responsibilities in terms of who's doing what. You should also then have a mind to collating due diligence and putting together your due diligence material. That is, an updated business plan, your financials, and your key contracts and agreements. You should start collating those. Be well prepared. Whether it's these days, it's normally via an online, a cloud-based digital data room that you would store all this in, so that those that are looking to conduct due diligence on your business can do that easily and readily. From there, you will normally move to a term sheet where you start negotiating the terms of the raise, the key commercial terms, and then you move on to sort of the formal legal documentations and closing. The one thing you should be mindful of as part of this process, it can take 6 to 12 months to close off on a funding round, and when we do this presentation at times with our friends in the venture capital world also, and you should just be wary that it can take time for a business to close a funding round, and so you need to be well prepared and be thinking ahead, right? So with that, let's move on to the concept of the valley of death, because it's something that is particularly relevant for startups that are starting to scale, and it's a phase in the startup's journey where it has undergone some of its initial rounds of funding via family and friends, for example. It's commenced operating, but it's yet to commence generating revenue. That is, your business is yet to commence generating revenue, as is demonstrated by the graph, right? So it is often the case that a startup does not have enough capital on hand to commence generating revenue, right? It's right, and as a result, the founders lack bargaining power to raise more funds, and aptly call the valley of death. An estimated 70% of startups go under during this phase, and so it's important to recognize it and be vigilant, right? Now, some of the reasons for this can be just as simple as pure financial projections and budgeting, but other reasons could be, unpredicted economic circumstances, by way of example, right? Like the pandemic, which we went through. Now, the reason for sharing this is because there are some tried and true methods to find your way out of this phase or avoid this phase. And I wanted to share these with you, right? And these are a lot of this might seem like common sense, guys, but you'd be surprised how many startups find themselves at 70% of them go under in this phase. So I thought it was worth touching upon. So what are the things you should be doing? First and foremost, be aware of your burn rate, right? That's the rate at which your business spends its money, right? So if you're in or approaching a valley, you should know how long you have before you will need further funding, right? So budgeting is critical. Financial projections are critical in the lead up so that you know when you will need to start seeking further funding. Keeping in mind what I said, it can take 6 months to 12 months, even at times, to close off a funding round. As you start, as you get closer to needing further funding, think about whether you have tapped out all your sources of funding from existing investors, right, on your cap table. Something that we do find very often is that founders will look externally before they look internally. So if someone has invested in your business once and believes in you, they go back to them first before you go externally, right? It can be a quick and easy way of raising further funds. The other thing I would always recommend is that have a hit list of early stage angel investors, venture capital funds that are likely to be interested in the business of your nature. So a lot of investors, for example, have very set investment criterias and they seek to invest in specific industries. So have a bit of a hit list ready to go so that when you do seek funding, you know where to go quickly. If you're unable to raise funds from professional investors, then consider other sources of funding. So crowdsource funding, by way of example, for startups that have got something cool about them or something edgy, or they have a social impact, can be a very it's becoming a far more it's just becoming a lot more viable now for startups to go through virtual and other platforms like that. So keep that in mind. The other thing to keep in mind is non-dilutive sources of funding. So that's grant funding. There's plenty of grants available out there, and so are you aware of them? And so applying for relevant grants can be a great source of additional funding. And then finally, what we see as lawyers very often, startups that think outside the box. Think about, have you considered other options? So other players in the industry that may be interested in partnering up with you, right? So by way of example, we've got a startup that's in the waterproofing space, and as it started to get closer to sort of depleting its funds, it entered into quite a clever arrangement, which we helped draft, with an association in New Zealand, which is a building association in New Zealand, that helped it enter into the New Zealand market. Right. And so it was able to enter into a new territory and start earning revenue from a new territory by partnering up with an industry player that was interested in its product. Right. And there was no that wasn't a customer of it. It was a partnership type arrangement. But just think about whether you've exhausted, who else could help you to get closer to your market base. So I just thought it was worth touching upon this concept of the valley of death, because it's a phase where a lot of founders get unwound, but it can be navigated if you think ahead. Thereafter, I wanted to speak to you about sort of what a typical funding round looks like, and I won't talk too much on this, but essentially, when we go out helping founders with their capital raising rounds, you have your pre-seed rounds, which is normally your family and friend rounds, where the startups are usually, the valuation will be anywhere from $1 to $3 million. You might raise somewhere between $200,000 and $400,000. As you then move on up the scale, you have your seed funding rounds, where the valuations, and these are broad brush rules of thumb, by the way, guys, that we see. The valuation might be $2 to $4 million of your company, of your startup, and you might be looking to raise somewhere between $500 to $1 million. All the way to Series A, B, C, and beyond. So the point I'm trying to make here is that, as you can see, the valuations, valuation is something that you need to be cognizant of. How do you value your startup? How do you value your business? A lot of it will be based on future potential, of course. As you start earning revenue, there will be other metrics that a lot of venture capital funds use, which may be a multiple of your annual recurring revenue, by way of example, at the bottom there, you'll see the mention of an ESOP, which is an employee share option plan. So as part of any funding or fundraising rounds that you undertake, what you will find is an investor will always want that startup to have set aside an allocation an employee share and option plan, which is essentially a way to incentivize new talent into the business by issuing options and shares to them as well, so that you're able to bring on new talent. I appreciate this is a little bit technical and commercial, so if you've got questions around this at the end, please do feel free to ask. The next issue I wanted to touch upon is the concept of dilution, right? And the point here is more than anything I'm trying to make is that as founders or the owners, the original owners of the business, at the outset, when you're likely to own you'll own 100% of the business, but as you go through the various funding rounds from seed, Series A, Series B, Series C, your holding in your business will dilute down. So at seed round, you can expect it to be diluted by about 20%, a further 33% as part of Series A, and so on and so forth. So while your shareholding is being diluted, hopefully that is being offset by increases in the valuation of your business, right? So while you're holding less, the value overall, though, is disproportionately should be increasing. So the reason for sharing this is we do come across founders that are very jittery about giving up control or shares in their business, but the idea here is you're losing control, but you're gaining value. Yeah. Next, let's talk about what to look for in an investor, right? So if, obviously an investor that will be bringing in money with them that's first and foremost where we're all looking to raise funds, right? But do think about, are they the right partner for you? And I do appreciate in saying some of these things. You don't always have, I guess, the bargaining power to determine whether an investor is the right person for you. You might just need the money. But where you do have choice and options, do put your mind to this. What will an investor be bringing into your business beyond their check size, right? So do they have a level of expertise or connections and contacts that will be profitable to your business? In our experience, the best startups and the ones that succeed in the early stage are the ones that have found investors that come on board who have some level of industry expertise that will help that startup, right? By way of example, we can look at two startups that we've helped recently. One was in the aged care space. So they had developed an app which was looking to disrupt the aged care space. They were able to bring on an investor on board who was a much bigger player in the market within that same space. And that investor was able to open up the overseas markets to them, in particular the markets in Europe, through its professional connections, which would not otherwise have been accessible to our client. This proved to be, as I'm sure you'd imagine, quite lucrative for our client and really helped them pop and move to that next level. Now, another example has been a client of ours, which is a startup in the oil and gas industry. Again, it's a tech company, but that's the industry sector in which they operate. Their strategic investment came from a Singaporean family office with a high net worth who was very well connected within the oil and gas sector. Having an investor with these sort of connections enabled this startup to straight away get an introduction to its key customers within the oil and gas space within Southeast Asia, right? So not only did they receive introductions, it also brought them credibility right away because of the notoriety of this family office that they got on board. So to the extent that the investor is just seeking a financial investment, the deal then, it's because there are investors out there that just want to be a passive investor. Well, that can be fine as well, right? There's nothing wrong with that, but just ensure that where that's the case, that the deal is structured such that the overall agreement also reflects the fact that they will just be a passive investor, and that's where I guess legal help is useful. But the overall message here is that think about what an investor can bring to your business or as a scaling business beyond just the size of their check, right? Now, the next phase of this is disclosure and due diligence. And I know that sounds boring, but I think we'll touch upon some fairly interesting concepts here. So now, we've reached a stage where the prospective investor, we know they're probably a good fit for your business, and they will now want to do a level of disclosure and due diligence on your business, right? They want to kick the tires, so to speak, to determine whether they want to, go ahead with this investment. So, and as part of this, do note that there are legal obligations on any company that is looking to issue equity in Australia, right? And this includes the obligation to disclose certain information to prospective investors in relation to the shares and your business, right? And again, I'm talking broad brush, so but just do keep that in mind. And there's a duty for you not to mislead and deceive the market, right? And investors who are looking to be looking to do due diligence on your startup. So keep those sort of, this is common sense stuff, but do keep that in mind. So at the very outset, I touched upon as part of the due diligence phase, you're likely to be having to present to investors via a pitch deck or some sort of a presentation. And so let's talk about what are the sorts of things that an investor would like to see from you, right? So first and foremost, a breakdown of your product and services, right? So what is it that you are looking to create or sell? Right? What solution is that product or service bringing to the market, i.e., what gap is it filling? Right? They'll want to know market analysis around the product or service. What are people going to pay for it? And not only why, but why are people going to pay for it, and who is going to pay for it? Right? Who is your target market? How big is your target market? Right? And out of that, what percentage of that do you think you can secure? Who is your competition out there? Right? And why do you consider yourself to be better than them? Right? Then there'll be due diligence on your team, right? Who is your management team? Who are your co-founders? And why should they be trusted? Make it a point to really share information about your team. If you're passionate, experienced, etc., bring that out as part of your presentations. From what we see, poor teams hardly ever work, right? Conversely, what we have seen on many occasions is that impressive teams with ideas that you might regard not as sort of good or viable, they still do tend to attract funding over a team that is dysfunctional but with a great idea. Because ultimately, this is all about relationships. So when someone is investing in an early stage business, they're really backing the people behind it. So we often see it, especially in Australia, we undersell ourselves a lot. So do bring out the experience and the expertise and the passion of your team, right? The other part of the due diligence and the pitch deck will be obviously on the financial status of the company. If you're not revenue generating as yet, they'll want to know by when do you anticipate to be revenue generating? What sort of profit margins do you see? That sort of basic information, right? And then finally, why do you need the investment? What are you going to do with the money that you raise, right? So if someone is writing, is going to be investing 200,000, $1 million or whatever it may be into your company, they want to know how you're going to spend it. Very often in the early phases, it's likely to be on things like product development, on increasing your sales team to get to market quicker, etc., etc. So share with them how the money will be spent and how that spend is then going to help them achieve value, right? How it will increase the value of your business. So as well as the pitch deck, an investor is also going to want to do their own due diligence, and you want to do some things before the due diligence phase commences. So, and things that you should be wary of. Investors are likely going to want to have what's called an exclusivity period, where they just get to negotiate directly one-on-one with you while they undertake due diligence, right? Now, again, it's really useful to have advisors to be guiding you through these processes, because you don't want these exclusivity periods to become overly prolonged. You also want to be sharing information in a way that is commercially astute, I guess, because you are going to be sharing sensitive information about your company, about your business plans, about potentially your customers, etc. So you want to be walked through all of this, right? And then as part of the due diligence, you're also likely to going to start negotiating what's called a term sheet, which will cover off on the structure of the investment, the value that they're likely to be investing in your company, and any other conditions. The term sheet at this stage is generally just non-binding, but it sets their intention to want to enter formal agreements with your startup pending the completion of due diligence, right? So as a general comment, the best startups and the clients of ours that have done really well are the ones that are best prepared, right? They're not reactive. They're ready for due diligence. They're not waiting for an investor to give them a checklist of information. They already have it ready to go in a online cloud based data room, etc. Right? And again, this is where advisors can help you get your house in order. From an investor's perspective, a bunch of founders that look organized, it just sets the right tone from the outset. So these are things to be wary of. So as part of the information that you're sharing, the things that you need to be able to share enough information to give the investor the ability to determine and ascertain the value of your business, right? And therefore how much their investment as well, right? In this regard, you should have sufficient information about your financials, your financial projections, business and marketing plans, industry analysis, etc. Right? They will want to know that all your intellectual property is secure and where is it held. So intellectual property isn't going to be a big part of today's presentation, but as lawyers working in this space, IP or intellectual property is obviously the backbone of most disruptive businesses. And so any investor that is going to be investing in your business will want to know that the company that it's investing in owns all the IP that is of value, right? So, and very often, again, in the startup context, people with two or three friends or two or three colleagues, they might start working on an idea before a company is even registered, and inadvertently they might not be aware of it, but they have already started creating intellectual IP rights in whatever they may be creating some code or some tech, designing a platform which they still retain themselves. And so a couple of months in, they might then register a company. So there may be the need to assign all your intellectual property rights from yourselves individually to the company, right? They'll also want to do a level of stress testing on your product or service, right? This is something you shouldn't be trying to avoid. One of the best ways to get someone excited about your business is to show them the customer experience, right? Depending on what point they come in at, if you have a product where you are now more advanced and are looking for a high level of funding, then yeah, a level of technical due diligence is something they will be doing. And they'll normally work with your developer or your CTO to determine whether your idea, I guess, stacks up. They'll want to see your business plan for obvious reasons. And then an investor is likely to want to also see your key agreements that are in place between the founders, employees, your customers, and your suppliers. So well-drafted agreements at the outset can again make you look organized as opposed to a startup that has been doing things on the back of an envelope, right? And all of these things create value, right? Because you've got to remember valuation when it comes to the startup market can be quite a fluid concept. You're not there is not much there in the way of revenue, or there might not be there much in the way of asset value. So it's a lot of the value is projected value. So when you've got things like agreements in place, a business plan in place, your projections in place, and you look organized and like you've got your house in order, this all gives a perception of value and that you're an organized group of people that are worth investing in. The other thing to think about in terms of your agreements, where you're not yet at market and you don't have any customers, if you're able to show any evidence that your product or service has there is an appetite there for it. So, for example, any letters of intent or validation from a market, that can go a long way, right? So, so to the extent you have, by way of example, letters of intent from key customers, we've seen this before. So startups that will go to some of their key customers and say, "Hey, if we develop this, would you be interested?" If they say yes, they'll get them to put that in writing. It's obviously non-binding, but it shows intent that they've got interest in their product. Even anything that you might have done with universities or government similar agencies where they've done pilot programs to validate your product or services, you should include all of that sort of information and present that to investors as part of your due diligence, because it all validates the legitimacy of your idea and your business. Okay, so from there, I would like to move on to sort of structuring your investment and what that looks like. There are a number of ways to structure a capital raise, and very often investors will sort of drive how the investment is to be structured. But you need to also be thinking about what is the most commercially viable means for your startup to raise funds. So at the outset, I touched upon crowdsource funding, grants, etc. So you need to be thinking about this. How should we be looking to structure the investment? And so let's just talk about some of the more common structures. So first and foremost is an equity investment, which is essentially an investment in your company. You issue shares to the investor, and they give your company some money, right? And in exchange, they'll get either an ordinary or a preference share in your business, right? In your company. To the extent that preference shares are issued, they will usually attach special rights in favor of investors. For example, what are called anti-dilution rights, liquidation preferences. I wouldn't go into what those terms mean, but by all means, feel free to ask questions at the end if you have any. But just be aware that as part of an equity investment, you may also investors may also require a seat on your board, so directors to be appointed and decision-making rights. And we do find at times founders get a bit jittery about all of this. Just remember, again, we do work with more sophisticated investors and venture capital funds. Yes, they do want a level of control, but they also do provide significant value the other way. So they are, as I mentioned at the outset, they are likely. Firstly, they want to see your business succeed, right? Because they're investing in it. So by putting a director on your board, they do get a level of oversight and control, but that may also result in you getting introductions to key suppliers, customers, other investors, etc. So certainly in our experience, this is again general rules of thumb. The startups that have done really well on our client base are the ones that have sought some level of sophisticated / venture capital investment and have given up some of the control as a result, right? You can also structure your investment via sort of quasi debt instruments such as convertible note. A convertible note is an instrument whereby an investor gives you some money, and then they normally have an option to have those funds repaid, or they can at a later date choose to convert their funds into shares in your company. Broad brush. Then what's becoming a lot more prevalent now everywhere around the world, including in Australia, are safe notes or simple agreements for future equity. We generally are negotiating one or two safes at any given time on behalf of our clients. A safe, as the name suggests, it's a simple agreement. It's a quick way of raising funds where an investor, they are very interested in your business. They want to put funds into your business, but they don't know how to value it. And that conversation around valuation is entirely, I guess, deferred, because what a safe does is it allows an investor to convert the amount they've invested into shares at a valuation that is triggered at what we call the very next funding round, right? When the very next investor comes in, which is likely to be a sophisticated investor, they will set the valuation when they come in, and we then come in at the same value, subject to some sort of a discount, right? For writing our check first. So again, I'll leave it at that for now. If you've got any questions around convertible notes or safes at the end, please do ask. So, I guess in terms of investment structures, etc., the main point I'd like to leave you with this is that give it thought before you go to market. What's the best way for you to raise funds? If you are a startup that needs quick funding and hasn't given much thought to value, for example, a safe may be a good way to go. If you're a startup that is more progressed and is looking for a larger check size, then an old school equity funding round may be the best mechanism for you. In terms of trips and traps, we've seen investors. What was I going to share here? Yeah. So in terms of trips and traps, what we do see from time to time is, generally speaking, everyone within the startup ecosystem is looking to the right thing by each other, and I really do think that's been my experience. Even venture capital funds, investors, etc. Yes, there are high expectations when they invest in startups, but they generally do seek to do the right thing. From time to time, we have come across examples where sophisticated investors present agreements to a client or a startup of ours that we might be acting for, that on the face of it looks like an equity investment, i.e., we will invest $1 million, you will issue us shares in your company. But then there are funny provisions in this in the agreement whereby after 5 years you have to give us a guaranteed return, right? Now, while on the face of it, it's termed a subscription agreement, that is really akin to a loan arrangement, right? And carries a lot of risk from the perspective of the founders, because it's a startup business. Risk is obviously high. If you could guarantee returns, I mean, that would be, there would, you can't, right? Essentially is what I'm trying to say. So be wary of, I appreciate that in the startup ecosystem where you have where financial resources are scarce, sometimes you might not want to spend a lot of money on legal, for example. But there are times to really be focusing in on legal, and certainly when you're raising capital for your business, that is one occasion, and you need to make sure that any agreements with investors are vetted. Aside from that, I think I've touched upon the fact that you also need to get comfortable with the fact that as part of seeking investment, you will be giving up a level of control, both in the form of shareholding and in the form of the day-to-day operation of a business, right? So if someone is investing funds in your business, they will want oversight on your financials. They will want oversight potentially on the way the business is operated, and they might want a seat on the board or observer rights. And these are things that do get negotiated. I don't think within reason, I think all of these things can be negotiated in a way which creates a level playing field for both the investor and the startup company. Over and above that, I think we can move now to key agreements, which I'm conscious of time and I want to leave time for Q&A. So in terms of key agreements, I guess the main issue here, or the main things are that in the context of an equity funding round, I've mentioned a term sheet. So that's the starting point which sets out the commercial terms of the bargain on which someone will come on board. From there, you move on to more formal agreements, which is a subscription agreement, which formalizes everything. I'll give you $1 million. You'll give me, X number of shares in your company. And then there's the shareholders agreement, which is really the document that is the most, I guess, heavily negotiated as part of any funding round. A shareholders agreement is an agreement which sets out the rights and obligations of shareholders as a whole, as against each other, or as amongst each other, I should say, and how a company is to be governed and operated moving forward. So when an investor comes in particular, a sophisticated investor, as I've mentioned, they are likely to want to have certain controls over the way the business is managed and operated and the way decisions are made. And these things are normally set out in the shareholders agreement. So that tends to be where a lot of the focus and attention is spent. I have kind of gone through it a little bit quickly in the end there, because I'm cognizant of the fact that there's quite a bit of information that I've shared today, and I want to leave enough time for Q&A. So I'll leave it at that. I'll wrap it up there. I think that gives you an overview of sort of the capital raising journey and some of the key issues you should be aware of. But are there any questions that you might wish to ask? I've got, I think Elaine's got her hand up. Elaine, do you want to? Yeah.
Yes, hi. Thanks for explaining and going through the details. I'm just wondering with regarding to formal articulation of the testing when you're talking about the proving to investors part of due diligence for information about testing that you've done to prove the validity of the product. How does that sort of look like practically, and what is actually outlined in those sort of products? Those sort of like information sheets that we share.
Yeah, so I mean, I guess there's no prescribed or proven, there's no prescriptive answer for that. What I mean there is, we have clients that have. So I gave you the example. We've got a client in the mining tech sector at the moment, right? That has developed a platform which is targeting mining companies and the way they operate. I'll leave it at that. But what they did in their very early phase, they went and interviewed a lot of their key clients and target clients in terms of their interest in a product of the nature that this client that our client was developing. And as they were doing this, they were getting them to sign just informal letters of intent that they would be willing to subscribe for and pay for a product of this nature if it was developed and had the functions as described. Now, these letters of intent were of huge value when this client of ours was doing its early stage funding rounds. So anything that you might have done in the form of getting out there and outreach to validate your product, like include that in the due diligence, or at least in the investor presentations Q&A process that you might have with investors.
Yep, thank you for that. And would you say that instead of a letter of intent, that something like a pre-ordering payment amount, like for example, like a deposit of a certain monetary amount of money, would actually be also sort of part of this due diligence information to send through?
Well, that's arguably even better, Elaine, because you've actually been able to secure someone actually giving you a deposit to say that yes, we would be yes, absolutely. Short answer. Yep.
Yep, thanks for that.
Yeah, and Rahul, we have a couple questions in the chat. First one is from Claire. At what stage is typical for founders to begin paid a salary, and what amount is advisable in terms of keeping investors interested? And then how do you actually find investors?
Okay. In terms of at what point in time, well, I mean, that really that's a very commercial consideration. I mean, can you afford it, right? So at the outset, we do, by the way, always recommend that founders do put in place agreements with the company just to acknowledge the fact that they have started working there, even if it's on a part-time capacity, to acknowledge things like their leave entitlements, etc., as the companies, as you go through the company journey. But when should you start paying yourself something? Well, once you can afford to do so. So generally speaking, that is likely to be at least when you've started to get your first couple of customers in, right? Now, in terms of investors and what they would expect to see, investors they want founders to be remunerated. They want them to be looked after, because from an investor's perspective, there is no bigger risk than a founder exiting its startup and then what have they really invested in. So they don't have an expectation that you don't get paid, but within means, right? So by way of example, early stage startup founders we have seen have in place arrangements where they might be getting paid anything from, I know this is going to sound a bit silly because it's a broad range, but anything from $60,000 to $150,000 a year, right? Depending on where they are in terms of their journey and commercially viable, what is commercially viable for them. But and how do you actually find investors? There are a lot of databases out there where you can find lists of venture capital funds, etc., which I can share after this with Ryan to share with you. People like us, we generally tend to open up our contacts and networks to our clients when they're looking to get closer to fundraising. But it's early stage venture capital funds are fairly easy to find by searching the net. They actually normally have quite detailed descriptions of their investment criteria as well, in terms of what they look for from prospective startups and investors. So it's not hard to find. Melbourne, yeah, Andrew's mentioned Melbourne Angels, yes, absolutely, which is a great blue chip angel investment group, among others. So yes, there are many examples out there. Sorry, what else am I answering?
Yeah, I'll get them right now. I agree. We can definitely get you guys a list of the investors in the after the chat. There is several databases out there, whether it's domestic Australian investors or angels or international ones. So don't worry, we'll get that list out to you guys as well. A couple more questions. This is from Rajan. Are the investors only interested in the startups who return X amount of return within Y amount of time frame? What about the startup which are more driven by social impact first rather than profit driven from day one? Could there be a potential investors who would be interested in these type of startups?
Okay, sure. So, by the way, I do want to touch upon Andrew's comment above about including a copy of your R&D incentive as a good. Yes, absolutely. Because in the early phase, R&D incentives, when you are pre-revenue, you do get incentives back, and so that's a great source of cash flow. So you should always include that detail. Rajan, so to answer your question, if you're seeking venture capital investment, yes, as a broad rule of thumb, yes, they are interested in startups who can provide a great return in a fixed amount of time frame, because a lot of these funds are set up whereby they themselves need to make returns back to their underlying investors. If you're a social impact startup, there are certainly investors out there that are looking at social impact startups. And as I said, it's worth doing some research on this stuff, because they will invest in social impact startups, and they do have that's likely to be their niche. There are also other platforms like crowdsource funding platforms, which can become a good source of funding for ventures like that, because you can raise funds from the public at large, because they are likely to be more enthused by some with something that tugs at the heartstrings, I guess. But if you're looking at old school venture capital funds, yes, that is right. They can have prescriptive criteria for funding, but that's not to say that social impact startups can't get funding. There are means and ways. Yes.
Yeah, and we one of our partners actually is a social impact fund. It's called Giant Leap. They are one of the few that invest in those impact type of environments. We have another question from Mark. If my startup has secured funding from an accelerator for X percentage equity already, but I joined another accelerator offering funding for no equity, is there something that I need to consider?
Oh, look, it really comes down to over and above. If they're look, there are plenty of great accelerators out there, and if they are sure, they may be taking equity, but you've got to do an assessment of what are the other value adds that they're going to be providing. Well, in exchange for, I appreciate they're taking equity, but normally, as I've said to you as part of this presentation, they do look to open doors. They do look to open contacts and connections. And if they are providing those intangible additional value adds, then you need to consider that as part of making a decision of in which direction you go, because you're saying there's an accelerator offering funding but no equity. So what I just wonder what's in it for them, though, right? So I wonder if in that case you're not going to be getting the same level of support and assistance as you might be in the first. Now, but you need to consider that. I mean, yeah, I don't know the overall details, but I would suggest you need to consider all the benefits that come with each accelerator.
Yeah, I would agree. That definitely is, we offer some pre-accelerator courses at the Startup Network, but we don't take any equity, and they're really just because we support founders. But if there is a established accelerator out there and they're not taking equity, that would probably give me a little bit of pause as to what is the reason there. So, good answer. We have another one from Keanu. What does payment look like to investors after an agreement is made? Say when a company starts operating, if it's not creating profits, valley of death, to when do you start earning profits? Is that when you pay your investors their portion of the profits?
No. So equity funding, they are as I said. So you have to be wary. That I gave an example of a client of ours that had a provision in an agreement which was being sought of them, where they have to provide a return by a certain number of years, right? And we obviously negotiated that out of the agreement because that becomes almost like a loan arrangement where you have to, if it's an equity funding scenario, they're putting money in your startup, they're getting shares in return. There's generally speaking not a requirement to repay within a certain fixed prescribed amount of time. What they're hoping for, these investors, is that your value and your ability to attract customers, etc., will improve with the funding they're giving you, because you're going to apply it in the right way. You will increase their value. You will and then there may be an exit event, which may look like a sale, a trade sale to a larger player in the market. It may be a listing on an AXA, on the on a stock exchange, etc. That's when they cash out, right? That is likely to be when they cash out, right?
Excellent. And then we have a couple more questions. How does future fundraising rounds look like for sophisticated investors after a crowdfunding initial funding round?
Yeah. So yeah, if there's no, I hope there's no, well, if there's someone from a crowdfunding platform here, they can take this question as well. I'm not sure if there is, but look, in the Australian context, certainly we do find that venture capital funds do not like it if you've already gone through a crowdsourced funding round, because that means your cap table is now messy. It's because you'll have a lot of smaller investors on there. Venture capital funds do like to come on board and thereby appoint a director and control some of the. When I say control, it's not even, they want oversight and the ability to have oversight over the way the company is operated and controlled. And going down the crowdsource funding round early doors probably does make you less attractive to VC funding down the track. Yeah, in Australia, I've been told it's different in the US, but in Oz for sure.
Yeah, I would agree, Rahul. And crowdsource fund may be another alternative to VC angels. What are the downside risks from a founder's perspective? We kind of just went into that a little bit. I think the cap table gets a little bit messy. And it's sometimes a lot of expectations on the crowdsource, whether they want to see a return right away. The venture capital game is usually a 10-year window that these VC sophisticated investors are not going to be looking for a return, in 6 months or something. But sometimes in the crowdfunding space, it can get a little bit messy. How much equity or shares to give up for a seed crowdfunding round? That's from Elaine.
Yeah, so seed rounds. Sorry, for a seed crowdfunding round. Look, it really comes down to valuation and how much you're looking to raise. We have done a number of crowdfunding rounds, and in terms of, I believe they normally go from anywhere from 10 to 20% around that sort of. And the way and what we'll normally do is we update the governance documents such that the founders don't lose control, notwithstanding the influx of the new sort of group of investors. The constitutional documents are updated so that you don't lose control of decision making protocols, etc. I can see these comments around MAP and Monash. Yep, absolutely. We do a similar program with MAP where we provide a fair bit of did these sort of seminars. Yes, these are great programs, guys. These are smaller check sizes. So look, what I'll say with accelerator programs is and there are a number out there that just have very much prescribed. We will invest 200K at a $2 million valuation, right? So they will be taking equity. But if someone is writing a larger check, you can expect obviously for them to want some skin in the game, right? And an entitlement to some of the equity in your business. These are smaller amounts, but not to say that these are great programs that have been mentioned about Monash and MAP. Yep.
Yeah, I agree. I think that's it's a wonderful part of this Australian ecosystem. There is some programs out there. These are pretty relatively small checks, but they can give you that little juice in the beginning to get to where you need to go. I don't have any other questions on the map. Does anybody have any questions they want to raise their hand for or speak out loud before we wrap up? Okay, great. All right, wonderful. So we'd like to first thank you, Rahul, for your time today. Really great discussion. We've recorded this session so everybody will be able to access it afterwards. And then we will make sure to send out that list of investor the database that we're talking about as well.
Yep.
If anybody has any questions for Rahul, the email address is right there. It's hello@alliedlegal.com. Rajan, you have a question before we go?
Yeah, just a final one. So as Rahul said, like if we go from crowdsourcing to VC, there might be some issues. Would that apply for the accelerator program as well? Like if I go first round on accelerator program and then I go to VCs or investor, would that be the same? Like they would be less interested kind of thing?
No, no, because with accelerator programs, the you're still only getting one investor that comes on board. So I don't know which accelerator program you're going through, but it's going to be that one investor that will come on board. Whereas with crowdsource funding, the issue is that you're going to the public at large, and so you might have overnight 50 to 100 new investors on your cap table. But with an accelerator program, it's going to be one. The other thing with accelerator programs is, if anything, it's going to be they're looked at quite favorably, because those accelerators then, as you go down the your life cycle as a business, they're likely to open up further doors to venture capital funds to you. Actually, quite the opposite.
Yeah.
Thank you very much. Thank you.
And then there was one last question from Louise. To raise capital, you have to be a permanent resident or an Australian citizen.
No, no. I mean, look, to set up a company in Australia, you do have certain requirements in relation to residency, and especially in terms of an Australian resident director. But to raise capital, look, it really, as a general rule of thumb, the answer is no. But there will be certain venture capital funds out there where, for purposes of their early stage venture capital limited partnership requirements, there are for them to be able to adhere to those, they do have requirements that, around Australian citizenship, etc. But as a general rule, there's no such requirement. But I'll have to caveat that in some instances that it may be. Yep.
And then some more questions are coming in. So, does accelerator programs available for early startup only, or can startups that want to scale join as well? I mean it as the funding equity.
So accelerator programs are normally aimed at more early stage startups, but certainly there are funds out there, venture capital funds that will invest in startups from very much seed stage all the way through to Series A, B, C, more startups that have increased. I actually did a presentation yesterday to a group called Quantum TX. Now that's an accelerator program which is in the deep tech, mining tech, and space tech space, which is more scaled up startups. Yeah.
Great.
Yeah.
Andrew, you had your hand up. Do you have a question as well, Andrew?
Oh, yeah. So just for disclosure, I'm with the Melbourne Angels. So just want to echo with Rahul's point that angel groups tend to have a positive view to accelerator programs and incubator programs, mainly because startups or SMEs have gone through the rigor of the commercialization pathway. So we tend to have more of a favorable view because they've been through identifying, what their product fit is out to market. So when they come looking for funding, they have some commercial objectives already set up.
Yep.
Cool. Excellent. Well, thanks everybody. If anybody, again, if you'd like to get in touch with Rahul or anybody over at Allied Legal, we would definitely recommend for all your legal needs. There's the email address right on the front there. My name is Ryan Burns. I'm the head of community at the Startup Network. You can always reach out to me as well at ryan@thestartupnetwork.com.au. We'll have a variety of events this month in May, especially our headlining event with Microsoft, which is Building with AI. It's a mini boot camp that we're starting off in a couple weeks. That's where you actually learn to build in the world of AI from the leaders in that world. So it's really good, and it's at Microsoft's offices. So it's really a great example. Other than that, thank you so much for joining us, and have a very lovely day. We'll see you at the next one.